What are oil and gas ETFs? Have you ever wondered how investors can tap into the oil and gas industry without buying barrels of oil or individual stocks? Well, let's break down the concept of oil and gas exchange-traded funds. These funds are traded on stock exchanges and offer a way for investors to gain exposure to the oil and gas sector. They pull together assets related to energy, which can include shares of oil and gas companies or crude oil futures contracts. This means you can participate in the performance of the oil and gas market without the hassle of handling physical commodities. From a capitalist viewpoint, these funds representing an efficient method to allocate capital in a vital sector that fuels economic growth. They reflected the dynamics of supply and demand, as well as the profitability of companies in a competitive market. One of the key features of oil and gas exchange-traded funds is diversification. By holding a collection of stocks or contracts, these funds help reduce the risk tied to investing in a single company. This approach aligns with the principles of risk management in capitalist economies. Accessibility and liquidity are also important. Since these funds trade like stocks, investors can easily enter or exit positions based on market conditions. This liquidity supports efficient capital markets, allowing for quick adjustments to investment strategies. There are different structures within these funds. Some track the price of crude oil directly through futures contracts, while others invest in a portfolio of oil company stocks. Futures-based funds may provide closer tracking of oil prices but can be influenced by market phenomena, which might affect returns over time. On the other hand, equity-based funds reflected the financial health and growth potential of oil and gas firms. Cost efficiency is another advantage. Generally, these funds have lower management fees and transaction costs compared to purchasing multiple individual stocks or physical commodities. This makes them a more economical choice for many investors. Investors can also benefit from the growth of the oil and gas industry through these funds. They may receive dividends from oil companies, aligning with investment goals of capital appreciation and generating income. In capitalist economies, oil and gas exchange-traded funds serve practical purposes. They provide portfolio diversification for both institutional and retail investors. They can also act as a hedge against inflation or geopolitical risks that may impact energy prices. Furthermore, they facilitate capital allocation to a sector that is essential for industrial production and transportation. In essence, oil and gas exchange-traded funds are market-based investment tools that help channel capital into the energy sector. They reflected market trends and investment strategies while allowing investors to engage in oil and gas production activities, all while managing risk and maintaining liquidity.